Good day, everyone. Thank you for joining us once again here at Seafried and Brew and BBC for our economic briefing. And for this briefing, we're going to review over the performance of the Community Bank Benchmark Group for the second quarter of 2023. And for those who have just joined us, this benchmark group includes institutions with assets between $100 million and $5 billion. And they have a community focus. This is specifically for community financial institutions. To jump right in, we want to look at the quarterly growth rate of these banks, and we can see on an aggregate level, the asset growth slowed down from what we saw in the first quarter, when the first quarter came in at 1.67 and the second quarter at 0.96%, so just under 1%. And that just shows the overall slowdown in the growth rate of the bank's balance sheet, and particularly of deposits. And we see that outflow of deposits down below, where we could see that the deposit growth rate, overall deposits, actually declined by 0.22% from where it would increase by 0.89% last quarter. But when we start to strip out those broker deposits, we see the actual non-broker deposits, or deposits net of those brokered money, actually went down 0.55%. So it shows that overall slowdown in the outflow of deposits that we saw in the second quarter. In the first quarter, we saw it a little bit. The net broker deposit level came down just 0.01%, so basically stayed the same. However, in the second quarter, we saw that outflow speed up, and we'll talk a little bit more about that in just a few minutes. But the overall loan growth actually picked up when we look at the overall level at 2.87%. So that's a strong level of loan growth from what we've seen over the past several quarters. And in fact, in the first quarter, that growth was just 2.15%. So we saw that increase. Now, I know with the banks that I work with, we're starting to see some of those pipelines begin to narrow at some institutions. So in the third quarter, we might see a reversion back down to the lower 2% or below in terms of that loan growth. With deposits, as an industry, we've seen the industry in terms of the U.S. commercial banks, the deposits levels coming down from where they peaked out back in April of 22. And we saw a pretty rapid decline in the first quarter this year. And that was around the time of the SVB failure. And that spooked the market. We saw a lot of the deposits kind of leave the banks. So we saw that flow down, and then it kind of moderated out, and we begin to see that moderation. However, we see there's still a pretty significant surge with inside the deposits, still at $1.1 trillion. So this dotted line represents the trend growth that we saw, the weekly trend growth over the past 6 years prior to the pandemic, growing outward. So we can see there's still a fairly significant amount of surge in deposits that could potentially unwind in here over the next couple of quarters. But overall, when we look at the financial performance, we did see a decline coming down 5 basis points for return on average assets. However, average assets continue to remain above 1.01% for the Community Bank Benchmark Group. Now, when we split that up into our subcategories, we can see a little bit of a dynamic flowing down below that 1%. So when we see these subgroup ROAs, overall in the subchapter S institutions, down slightly coming down, just at 4 basis points down to 1.29%, so remaining above that 1% level. But when we look at the stock institutions, so these are institutions that have stockholders, either private or public, but they also do not report under the subchapter S. So they don't have that declaration. We can see that came down about 3 basis points at 0.96% for the second quarter here. And the mutual institutions fell from 0.52% in the first quarter 22 down to 0.46%. So overall, we do see that deceleration in the return on average assets, not only just the industry-wide, but also in the individual subgroups that we tend to look at. And a lot of that was due to this pressure on net interest margin. We continue to see the net interest margin under pressure because of the rapid increase in these deposit pricing. We peaked out at 3.61% in the fourth quarter of 22, and we've gone down to 3.39% in the second quarter of 2023. But notice we're still above where we were last year in the second quarter at 3.27. So we still have some ways to come down until we're down at levels we were last year. When we look at the components of net interest margin, we continue to see yielding earning assets making headway, picking up, and this will continue to happen as long as the Fed moves that Fed funds rate. And we see the overall level of market rates with the Treasury curve, stubbornly pushing up. Now, when we look at cost of funds, we can see the tremendous increase in cost of funds over the course of the past year, from where it was in the second quarter of 22 at 0.26%, going all the way up to 1.33. Now, this is overall cost of funds, so this incorporates the cost of borrowings in there, as well as incorporating those non-interest-bearing deposits. When we look specifically at interest-bearing deposits, we can see these levels jump even quicker, from where we were back in the second quarter of 22 at 0.33%, moving all the way up to where we are in the second quarter of 23 at 1.65%. So collectively and cumulatively, when we look at the industry, in terms of the average cost of interest-bearing deposits, that beta is coming in at about 26.4%. So that's a pretty significant increase throughout time. Now, this is all interest-bearing deposits. So we look at both looking at both non-maturity deposits and time deposits collectively together. And we go look at these numbers state to state, look at the averages, pick where your state is and see how you compare. The highest number here we can see is Rhode Island at 2.98%. So that's the overall question, is how high will we see these levels go? When we look at the national average deposit rates as reported to or by the FDIC, we can see the tremendous growth year over year. This is back in June of 22, where the 1-year CD rate was 25 basis points, and now the average 1-year CD rate is 1.72%. So significant increase. And of course, this does not reflect the specials that are out there, because we can see specials at 12 months, 13 months, 18 months at 5% or even above 5% at some institutions. So that kind of weighs on the overall increase of the cost of deposits. But it's not just interest rate driven. We've also seen this trend in the deposit mix kind of move back to where we were pre-pandemic. Notice When we look at the deposit mix, savings and money market accounts, they move quarter to quarter downward. We saw savings move from 20% in the second quarter of 22. This is year over year, to 16%, 16.8% in second quarter of 23. So we've seen that migration move out of savings and money markets flowing into those time deposits. You can see those time deposits in the second quarter of 22 at 16.9%, moving up to 23.9%. So we've seen this migration in the deposit categories, and that alone would increase the overall level of the cost of funds. But not only that, year over year growth rates, we've seen this, and we talked about this a little bit before. The non-broker deposits actually declined year over year from where they were in the second quarter of 22, down 0.75% compared to prior year growth rates, where we see 9.9% in 22 and 15.6% in 21. And then, of course, in 20, with the stimulus that went through the system at 20.1%. So significant slowdown in terms of the growth rate and actual contraction when we look at the second quarter of 23. That contributing a fair amount to the impact of that cost of funds and the cost of interest-bearing deposits. When we're looking at net overhead, which would be that second primary driver of earnings, we can see the level of net overhead, which, if you recall, is the difference between non-interest expense and non-interest income over average assets. So the lower the number, the better. Picked up year over year. We're at 1.92% compared to where we were last year in the second quarter at 1.79%. So overall increase, but throughout the pandemic, and because of the rapid increase in deposits and also assets, we saw improvements in net overhead. And now we're getting back to normalized numbers, numbers that we would have seen on average pre-COVID. And the components there, looking at the non-interest expense and non-interest income. Non-interest income moved down from the second quarter 22 down through this first quarter 21 or 23, and then moving back up in the second quarter 23 by just 2 basis points, but it is an improvement. However, look at where we saw non-interest expense continuing its upward trajectory. We usually have a little bump in the fourth quarter of 22, but if we were to eliminate that, we'd still have an upward moving line here. You can see where we are at the end of the second quarter of 23 at 2.45%. In terms of risk, our overall risk score continues to move up quarter over quarter, and this is just a trend that we've seen, and a lot of this has to do with that liquidity component where, with the deposits rolling out, this liquidity begins to increase in terms of that liquidity risk because we've pulled down on the overall level of liquidity. So we have the deposit roll off, but also built in there is the level of devaluation of the securities portfolio, that weighing on the amount of liquidity a bank has on the sidelines. That also coupled with the earnings at risk, which we measure by looking at the volatility of net interest margin over a 2-year period. And as you can see, we see that overall level of volatility continue to be high and increasing, and that is supporting that higher level of earnings at risk. Now we start to see some institutions with the AL model, with that asset liability management model, showing improvements, though, as we move through the next couple of years and we see the level of interest rates, that volatility there. But overall, those are the two risk levels that have elevated and pushed our overall risk score up. We do have capital in that moderate zone. This is down a little bit, some improvement with the retaining of earnings, improving those capital ratios, so that does have a benefit. But overall, we do see that coming down a little bit, and we haven't seen credit risk really move up into that moderate zone, still in the upper portion of the low level there, and that's one thing that we want to keep an eye on. And what we don't want to see is this overall credit risk begin to increase and move into that moderate zone. So that's what we have for you overall in this briefing, looking at that community bank benchmark group, and the performance fared okay for the second quarter, but riddled with the issue of deposit pricing and the liquidity issue that we're seeing with those deposits exiting some of our institutions. So that's what we have for you today. We hope to see you back here again next quarter. Have a great day, everyone.